Social Security is in essence, a government bond, linked to inflation. It provides you guaranteed, lifetime income linked to inflation. And so it is actually incredibly valuable. Well, a client that has, a lot of income in Social Security has a higher kind of, holistic allocation to bonds. And so you can take more risk in your portfolio and vice versa. Now, obviously, things like risk tolerance are important, but but portfolios don't exist in isolation. Portfolios are kind of the liquid instrument that you can use to allocate to kind of make someone's total economic worth as efficient as possible. Right, and so for retirement, that portfolio is being allocated and invested, with the goal of providing, income for life. Right, so a question then becomes, well, what is the risk of a portfolio that exists to fund a liability? And as a reminder, a liability, let's just call the liability the goal to have, say, $40,000 per year of income for 30 years. So the liability is what you're trying to fund in retirement. Okay, so what is the risk of the portfolio? Well, if you do kind of traditional mean variance optimization, you would define the risk as standard deviation, right? Because that's what it is, right? If you think about risk is volatility from a client's perspective. Well, but it's really not, right? I mean, the risk of a portfolio is not that it'll have high or low returns. Now, obviously, high or low returns can affect how someone feels about investing, but that's not risk. Another risk isn't benchmark risk, right? Obviously, doing well is important for client reporting purposes to stay hired, but it isn't benchmark risk. Risk for retirees is not funding the goal. Right, and I mean, that sounds, a bit obvious, right? Well, of course, the risk of a portfolio that exists to fund a liability is to achieve the liability, to fund that goal, but that's not how we actually build portfolios today. If you think about how you build portfolios for clients, if I had to guess, there's no explicit reference to the liability, right? Because for, a retiree, if they want income for life adjusted for inflation, inflation is a very important risk characteristic that should be thought about in the optimization process, right? And so this kind of leads to this idea of what's called, liability-driven investing, or LDI, and on the slide I call it liability-relative investing. Okay, and the goal, for this portfolio for a retiree should be to track that liability over time. Right, so I'll provide an example. Look at the upper left-hand panel. You see that orange line and that blue line. Okay, the orange line is the value of your assets. So we'll call that your 401k balance. Okay, the blue line is the value of the liability. So we'll call that the net present value of the cost of retirement. Okay, what you'll see in that upper left panel is this kind of zig and zag, where as the orange line goes up, the blue line goes down, etc. Okay, and so what's happening here is this idea that let's just say that the market were to go down 1 year by 10%. Okay, and inflation was, let's just say, positive 5%. Okay, your realized return as an investor in that instance is negative 15%. Right, because your assets went down in value, but your liability increased in value. So this kind of mismatch in your funding costs over time. Okay, for a retiree, the goal is not wealth maximization, right? The goal is to make sure that they're going to have their retirement income need paid for when they retire. So, a better perspective is one that says, okay, I want to build a portfolio that tracks inflation. If the fundamental goal of the portfolio is to have income for life adjusted for inflation, you want a portfolio where if inflation is low, the portfolio doesn't have to do as well, but if inflation is higher, the portfolio outperforms. And so that's what you see in that lower left-hand panel, where you've kind of smoothed those funding costs over time.